Okay, let me go in and share this, guys. Welcome back. Welcome back. We do apologize for the technical difficulties that we just had a moment ago, but I tell you what, we don't give up. We just don't, okay? Again, this is Mark Jones, iTHINK Mortgage, joined by Matthew Stansbury, our sales manager here. And we're going to give you a Valentine's Day edition, but with some good input, some things that you can actually convey to your customers. Maybe you're in need of this information as an actual realtor participant in our wonderful industry of real estate and mortgage. So that being said, Matt, how you doing today, dude?
I'm doing good. I'm trying to share this video real quick.
I just got it. I was able to share it.
There we go.
Now go ahead, do your thing.
I'm doing good. What's going on, guys? Happy Valentine's Day.
Happy V-Day to all of you other people out there. But that, again, I wanted to go back to what I was mentioning in the first take on this, which is in the comments, if you could, let us know what your thoughts are on the actual day of Valentine's. Is it a true holiday? Obviously not, because federal holidays don't recognize it. Banks are open, all that jazz. But is this just something that is made up in order to get us to spend more in Q1? I'd like to know what you think. But as we move forward, we want to get into mortgage rates. We've got a couple of articles for you. We've got a video that we're going to jump into. And then we also want to know what your thoughts are in regards to what type of content you guys would like to hear from us, because we're going to be doing this daily. Sometimes we're going to have to come up with some silly stuff to keep you guys entertained, even if we got to dance or maybe jump on this track that you hear in the background and bust a flow.
Bust a flow.
Yeah.
or create a holiday like Valentine's Day.
I really like that view. I like that view. That looks cool. So our first topic at hand is our mortgage rates. Mortgage rates are actually trickling up just a bit. There is a good reason for this, and it has to do with the CPI that came out. I think it was today.
Yes. Yeah, today. Today's Tuesday.
So the Fed intended or predicted that it would actually go, the CPI, the Consumer Pricing Index, would come down to about 6.2%, but it actually came back at 6.5, which, yes, that is down from what it previously was. But with all the rate hikes that we've seen in the past and most recently, it was supposed to come down quite a bit more. So that being said, I think Valentine's Day is not helping us very much, because folks are out there continuing to spend money that they don't have. But there's quite a few things that go into this CPI thing, which I'll talk about here shortly. But let's look at our rates that we have on the screen. I have to give a disclaimer of these are not our current mortgage rates. These are an average, a conglomerate of different mortgage companies nationally, so that Google can provide the consumers out there with kind of a good snapshot picture of what the heck's going on throughout the country. So as you can see on the screen, with a 700 credit score to 719, you are roughly looking at a 6.99% rate going conventionally. That is with 20% down. Do me a solid, JC, and move that down payment to 5%.
Ooh.
I'm loving this beat.
Right?
Yeah. Okay, so it didn't change much, but what you guys did notice is the less money you put down, the lower your rate will actually be, which is strange, but at the same time, it is what it is.
Whenever you're doing like a 20% down.
Yeah, when you're putting 20% down, the rate actually goes up just a tad.
Mm-hmm.
Yeah.
No PI.
What it has to do with, I don't know, the lender is financing less, so therefore they're not going to make as much, so they get it on the front end. I don't know.
Yeah.
I don't control rates, neither does Matt, so don't shoot the messenger, okay? But you guys can see what the rates are. I don't want to spend too much time on this daily. We'll just continue to give you a snapshot of what they are. Please make sure to get with your actual lender. And if you are looking to get a rate quote out there, give us a look at ithinkmortgage.com. But I wanted to quickly talk about something that I looked at, and it had to do with the shelter cost that does go into the CPI. And it looks like the shelter cost has, it's gone up obviously in the recent past to like 18% increase, but it has since trickled back down, but not down to where it was historically. So that's playing a big factor in this consumer pricing index. We've seen used vehicles, used auto prices go down quite a bit recently. But yeah, let's go into.
Do you think with the auto pricing, they kind of took the hit just like the home market where their values were super inflated too?
Oh, 100%.
Right?
I mean, it had to do with supply and demand, and we can blame the chips that are in vehicles, or we can basically just say, hey, they were holding their ground, making more money.
I'm like, whenever you go to sell a vehicle and it's the same price as the new one's kind of...
That's strange.
Right?
And here's one thing that I can absolutely say is true when it comes to vehicles versus property. Vehicles, the moment you drive off the lot, it loses value. Yep. Any which way you look at it until it becomes a classic, and it has to be a desirable classic for it to gain that value down the road.
And is it 20 or 30 years for a classic?
Classic is after 20 years. Yeah. 20 years, then you can get those license plates, say classic car, all that jazz. Back when I had the 72 Challenger, I did not care enough to have that done.
That was a nice car.
It was. But we digress. So let's jump into our first article. JC, can you throw that up on the screen? All right, Matt, you want to take this?
Higher mortgage rates is what the housing market needs now. The surprise of January.
Make sure you're talking into your mic.
Oh.
There. Whoa.
It was a little low. Hey. There we go. The surprise of January was how strong the economy started off the year, particularly the housing market. All it seemed to take for buyers to come flocking back was the 30-year mortgage rates to ease to near 6%, after reaching as high as a 7.25 in October.
Well, can you keep on scrolling? They see us scrolling.
Mortgage purchase applications are rising again. The glut of existing homes we expected as the market slowed last year never materialized. Home builders stocks have surged. Goldman Sachs Group Inc. now believes home prices will fall by 6% from the peak rather than its previous forecasted of 10% decline. The housing analytics firm CoreLogic is even predicting a rise in home prices in 2023.
So there's some contradicting information yet again there. I think there's a lot of economists that don't know what the hell they're talking about, whether they have an ulterior motive or I don't know, but we have not really seen a drop in our home values. We have seen a drop in the listing prices.
Yeah.
And that is for obvious reasons. You can only combat high rates so much with price. But you really can't drop the price enough to make up the difference in payment. And I don't think people are in the need to sell as drastically as they assume they would in order to drop the market enough. So back to kind of what this is saying is they estimated it to be a 10% decrease in property values, and it only came back at 6%. But I don't think that has to actually do with property values. It's more so just listing prices.
The market's actually coming back to where it needs to be, not, hey, we're decreasing price because we're not selling anything and inventory is going backwards. No, they're just kind of getting to where they need to be, which builders have a play on that also.
Yep.
And their houses have been over asking. I mean, they're controlling their own little market over there, right?
Grand scheme of things, realtors out there, if you're tuning in, the values around certain areas are heavily dictated by builder inventory. And if the builder is consistently raising their sales prices and they're making appraisal as far as the lending side goes, why would you stop increasing those? Well, once you get to a stopping point to where no one is buying, you're going to have an excess of properties on the market that need to be purchased. So they're taking that extra money instead of dropping it from the price. It would probably piss some people off that just recently purchased in that same neighborhood. They're using that money on the back end to buy down interest rates. Now, this in turn could be construed as illegal practice, but it's not, because they do it by way of a JV, to where they combine one company with another, put the funds in there, and that's how they do it. Because in the end, we as lenders, them as builders, realtors, sellers can only contribute based on the amount that is restricted upon us. Example, FHA, max 6% contribution. Conventional, max 3% contribution unless you put more money down, et cetera, et cetera. So how are they able to buy $30,000, $40,000 down on a interest rate only and provide that to the customer? There's got to be a backdoor situation going on there.
Little gray area.
Yeah. There is a video that I want to show at the end here that will kind of tie this stuff together, and I'm excited to share it with you. But is that the end of that article there? Let's see here. It seems the housing. Okay, we already did that. Let's see. Boop. Man, that beat.
Bump, bump, bump.
Goes hard.
Mm-hmm. The strength in the housing market is an unwelcome development in the Federal Reserve's fight to lower inflation to 2%. Fed Chairman Jerome Powell spoke last year about the need for a reset in the housing market. To the extent that the Fed's tweaking of interest rate is meant to help balance the market, the evidence so far in 2023 is that a rate of 6% is too low. To keep the economy from overheating, mortgage rates around 6.5%. Their close level on Friday get closer to that mark. This is a sobering reality, once again exposing the tension between the need to provide affordable, adequate housing options for people and the Fed's goal to stabilize pricing around a target of 2% inflation.
Whew, their goal is 2%. We're way off. We're way off. And kind of back to this drum that we've been beating over and over and over. That is interest rates, mortgage rates, the rate that the Fed loans to the other banks overnight, et cetera, for money is the only way to slow that in a grand scheme of things. If the bank is buying their money from the Fed at a higher price, well, they're in turn going to have to increase that from bank to consumer so that they can still make a profit, therefore the margin in there. And the increase that has been done thus far has not been enough to slow the CPI fast enough. I mean, if we're trying to go from 8 to 2, and we've gone from 8 to probably 7 to 7 to 6.
They need to increase it substantially.
6.8 to 6.5. That's not enough. It's not shocking the market enough to slow or stop what is happening, which is people spending money that they don't have.
They need to put a regulation on credit cards too.
Woo, if only.
Right?
Yeah, they would never do that. Unfortunately, they wouldn't. Okay, let's go to the next article. Or you know what? Was it the video next? Let's watch this video. So before you pop that on there, I want to give a quick caveat to the video itself. So separately, I have a company called Review of Consumer Education, providing that consumer with the tools and information to allow them to self-diagnose and determine what types of programs that are out there in their area that they qualify for without needing the lender thus far within that process. We're getting ready to relaunch within the next 30 to 45 days, but it thrills me to give you this video, and you'll see why.
Welcome back. In other news, the CFPB is shifting its focus to websites and other platforms that claim to help consumers shop for mortgage rates. In a new 27-page advisory opinion, the CFPB outlined practices that violate the Federal Real Estate Settlement Procedures Act, or RESPA. CFPB Director Rohit Chopra says that given the rise in mortgage interest rates, it is even more important for homebuyers to shop and compare loan offers. The CFPB is specifically targeting platforms that claim to offer comparisons, but instead are illegally directing people to lenders who pay referral fees. The agency noted that when this happens, people could get stuck with a bad lender or pay higher costs instead of the loan that is best for them. These illegal practices can include presenting one or more service providers in a non-neutral way. For example, highlighting a lender as the top option, even if that's not true. Another illegal tactic would be platforms that use internal formulas to give preference to lenders and steer buyers to those lenders without them knowing. Back in 2020, the CFPB published an FAQ about RESPA to help companies understand their obligations.
Okay, so do me a solid, JC. Go back over to either the rates deal. Now jump into that window and just type in, actually scroll down. Yeah, you should just be able to scroll down. Boom, boom, boom. Keep going, because we'll be able to literally see what this video is talking about. Boom, stop. Compare current mortgage rates today. Bankrate.com, Rocket Mortgage, NerdWallet, all of these different websites that are essentially baiting the customer in based off of a pretty interest rate with all these little fine print caveats that have points included. You have to buy in this area, have this minimum credit score, have one leg behind your head, all kinds of different things in order to get this rate, because it's just a falsity. And unfortunately, consumers have been, poorly educated or brainwashed into thinking that rate is the only thing that is important when it comes to purchasing a home or anything of that matter. Now, that being said, rates are important. I'm not going to say that they're not, but the idea of you waiting to purchase because the rate is certain amount, etc. In the last 5 years, I believe the average amount of equity that has been gained, and this is on a low end, is about $30,000 in the past 3 years of at least just San Antonio. So when a consumer is out there just solely looking at interest rates, and then they get baited into something that in the end, they go down this long process of providing documents, all the different things that it takes, and come to find out now it's time to lock in the rate and it's not what you actually signed up for, but you've already gone too far down that path to turn around. Some people think that they don't have an option. Some are ashamed to go backwards to the previous lender that did provide them the good customer service, the multiple options, things of that nature. I just want you guys to be aware that options are way more important than interest rate. Mortgage programs that are out there that maybe your lender doesn't offer or even know about should be a top priority for you to get with your mortgage lender. I'm going to beat this drum over and over, which has to do with focus on working with an expert. We know what we're doing. We've been through the trials and tribulations of an up market, a down market, and been able to provide our customers with the knowledge they seek in order to accomplish that goal in the best manner for them. So yeah, that it thrills me. What are your thoughts on that concept there, that video we just watched?
I don't know. I feel like there is a lot of bait and switch. I feel like a lot of clients come to me and they're like, hey, I'm getting this excellent rate over here at, XYZ Mortgage. Mm-hmm. And I'm like, well, can you send me the LOE? And they're like, yeah, they're killing it, blah, blah, blah. Come to find out there's origination, discount points, all this that is tied into their loan estimate. They are not even aware because they don't know how to read it.
Right.
Or the mortgage loan officer over there didn't even break it down to them because they're not able to communicate with them effectively. And I feel like, it's just one of those things where we educate and kind of walk them through the process and teach them like things to look out for. But if you're just online and just unexperienced with the process, you're going to get lost in the weeds and might get bait and switched, just like you mentioned.
And a lot of folks end up doing that after working with somebody that did provide them with options. And the worst that there's really not much we can do about, because they don't have the education and knowledge that we do behind the scenes, is when we give them the best customer service possible, provide them with their option, then it's time to lock in a rate, and they jump on one of these websites and think that we're liars. It's like, you get what you pay for. First off, if it's not a bait and switch and you're, let's say, getting a half a point better than what a mortgage banker on the streets can provide, well, what are you losing to gain that? Are you going to be doing all of the legwork on your process? Is it going to be a fumbled experience that you have? There's got to be something that is going to give, because there's no way that someone as a company can pay their loan officers to do a great job and still give those rates.
Yep.
You know, it's just not possible. Logically, it's just not possible.
What are you giving up? Time. How much is your time worth?
Yeah, absolutely.
Whether that be you going to get the documentation or just time in the process.
Mm-hmm. I mean, I've seen it many times where somebody was trying to convince a borrower to go FHA when all along they qualify for USDA 100% financing, lower rate, lower payment, the whole 9 yards.
Wow.
Why didn't they offer it? They didn't even know. They didn't know about the program. Why? Because they were new. They were inexperienced. So just another example of working with a lender that is experienced and knows what the hell they're doing. My gosh. All right. I think we have one more article to tap into, and then we can banter it up. Oh, snap. Valentine's Day spending is expected to hit $26 billion. That's a B.
Yeah, I was like, that's a B, billion.
One of the highest on record. First off, before we start this article, wow.
Yeah.
How is that even possible? I thought we were climbing or getting close to a recession, but yet
people are still spending money.
Record-breaking spending? Make sense of that. Well, let's find out. While consumers feel the continued squeeze of inflationary pricing, the outlook of Valentine's Day spending seems optimistic. If that's what you want to call it. Consumers are expected to spend $25.9 billion on Valentine's Day in 2023, up 8% over last year. The National Retail Federation and Prosper Insights and Analytics revealed that spending this year will be one of the highest number on record from February's holiday. This year, as consumers embrace spending on friends and loved ones, retailers are ready to help customers celebrate Valentine's Day with memorable gifts at affordable prices, stated NRF President and CEO Matthew Shea. What is this here? It just shows what spending was. And as we can see on there, 2010 low, and then it jumps over to 2020 and then 2021 going upwards. So from 2021 to 2023, oddly, our spending has increased. Now, one thing that I do want to make note that it does not mention here is, what if our spending was the same? But the prices were higher.
Yeah, I was thinking about the pricing being higher on the products, right? Because of inflation. Sure. Everything's driving up, supply and demand. But then you're also thinking everything is accessible.
It's too easy.
So easy. Oh, gift, Amazon. Whereas before, the man or the female would have forgot, like, oh man, I need to go get a last minute gift and there's nothing. But now it's like, I can order something real quick.
Yeah.
Yeah, I'm like.
I mean, I don't know. It just blows my mind at how hyped up this holiday gets. And I don't want to be a Scrooge. That's not what I'm getting at here. But what is the actual definition of Valentine's Day? Where did it come about? Wasn't it like Saint Valentine or something like that?
I was actually looking that up earlier. It came like they're saying back in 18 something, or it was after like Saint Valentine, and there was two of them apparently. One was a priest,
and the other was a gigolo.
Yeah,
I don't get it.
Yeah.
What are your thoughts on people spending money they don't have? And I say that confidently because our debt is at the highest level it has ever been historically, ever.
They make it too easy.
I agree.
I just think it's too easy. I think with mortgage, they have the right systems in place to eliminate like foreclosure and all these things. And that's where rate hikes come in. We're trying to battle inflation. But then when you look at other avenues, like people renting, like the same person renting 2,500 square feet and they're maxing out all their income, that same person couldn't go and afford a $2,500 payment.
Right.
But they can rent a home or rent an apartment complex for that price.
For the same price.
It's like, that's kind of strange.
That is very strange.
Right? I was thinking about that the other day.
Well, I mean, let's just look at the concept of putting value into things over something that could grow you wealth in the future. if everybody, I know this is outlandish, but everybody band together and said, you know what, we're not spending money this Valentine's Day. We're going to go out and do something as a family, as a couple, as a unit, as a whatever. What would it look like? I mean, what would our economy look like with all of these retailers that are dependent upon preying on people, consumers, to spend money to make their margins, et cetera, et cetera? What would that look like?
The rose business would go out of business.
Yeah.
Like, whoa. Well, I mean, I think it would advance our society. Like if we went in, I don't know how deep you wanted to get on that, but if you wanted to send $26 billion to go spend on medical research or something, like, whoa, where would we be?
Could you imagine if 1 year, instead of spending on things, we took that money and let's say you spend $20, I spend $20, he spends $20, whatever the case may be. And no, our ladies aren't worth or whatever, worth $20. But you're like, cheap ass. I like to do things instead of buy things. But the idea would be, let's leverage that into something else that would contribute to everyone. I just don't see that happening. Ever. We're just too much of a shiny object society, unfortunately.
Selfish.
Yeah.
Wow.
Well, guys, gals, we've got some good stuff within this episode, or I don't even call it an episode. It's just an update. Today's
another day.